Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Patrick, in this intro, we say that Practical Nerds is a weekly podcast. So if we include this one, in the year, we would have done, depending on how you count it, either 32 or 33 episodes, which is not bad, I guess. I mean, it puts us closer to once every 2 weeks, as in that we're closer to once every 2 weeks than once every week. But there you go, I guess. That's our best effort at being consistent with the intro.
Well, I also want to make sure that nobody gets too quickly too tired of us.
Exactly.
And, I at least think, hey, it's better not to talk than to talk ramblings or just factually incorrect things. So maybe sometimes it's better to just shut up. But I do think that, even 32 or 33 of that net new ones that we end the year with, pretty good.
I would agree. I actually, I mean, I was about to say I didn't think we'll get this far, although I unfortunately wagered for more episodes for some reason. Shouldn't have, but I mean, we'll end with 53. I'll take that. I think that's a good outcome for us for 2024.
Indeed. We're going to talk about something special, but actually before that, I wanted to ask you, did you buy any ServiceTitan shares? They IPO'd now.
No, I mean, I wish I had. Would have gotten a nice listing pop.
Yeah. I mean, it's again like 42%, I think, since the IPO.
I think it is actually more than that. So, if I'm not mistaken, the 42% was the day one pop. And I think then there was a IPO to listing pop, I think of a few percentage points as well. So I think and okay, full disclaimer, I don't know what's happened since day one, but the full day one gain was almost 50%.
Well, bankers doing banker things, right? Pricing like shit in order to create a great narrative for other IPOs. I guess none of us should complain because the IPO window had been freezing a lot. It's great to see it thawing this year. ServiceTitan being an adjacent space to construction tech. Congrats to everyone involved. I thought it was obviously very good for the industry. If you had followed also the analysis of the S1, it seems like that listing was due very urgently because otherwise they would have gotten into some really hot water with the IRR2 IPO deal that they had signed with the previous round investors. So I think they'll be happy too.
Good for them, and I'm glad. I mean, I would like to believe, especially given what we had discussed. I think in episode 50 or 51, I think it's beginning of a nice phase, a different part of the cycle. Hopefully, it'll be. I mean, we expect it to be quite rewarding for us. So let's see how long it lasts.
Definitely.
Yeah.
Definitely. So that's late stage. Let's go back to early stage, which is where we make our money before we actually return it, getting into the right firms, the right partnerships at the right stages. And so early stage, Shub, one of the topics we want to discuss is how we think about variable cost versus fixed cost. So what did you cook up?
Yeah, I mean, look, so, several episodes that we've done in Practical Nerds is about discussing what has become the norm or the default playbook in venture capital and discussing why it either might not always be right or perhaps isn't right at all, or maybe it needs to be applied very differently in the context of construction tech or AEC tech. So one very popular wisdom, which at many various points of time, both of us and most of our VCs have been saying, I would say in the last 15 years, for mostly for good reason, with the success of firms like Uber, Airbnb, and many of their similar sorts of models around the world, is hey, everything has to be asset light, everything has to be cloud usage or variable usage, right? Paper use or costs are only a function of when it is used, etc. And look, for the most part, for the right reasons, the usage and the asset allocations there were a certain type, and that has spun off lots of interesting models and opportunities, and we've of course seen quite a few of them. But there's an argument to be made, as I at least think you make a very compelling argument, Patrick, that perhaps it's not always about going with variable cost. Why not play the fixed cost game instead?
So let's okay. So we're gonna debate today the maybe unique or controversial perspective that founders in AEC Tech can take here, how to think about their pricing model versus their cost model with regard to variable and fixed. But before we go there, Shub, we probably need to do quick definitions. So
Yes.
variable cost. Variable cost is a cost that scales with your revenue. So as you spin up more revenue, the cost of goods sold, the cost to serve your customers, and which is basically the cost to serve your customers or the cost to produce any goods. Sometimes that would include logistics to deliver it to the customer. So basically, the cost to deliver the revenue, those
Mm-hmm.
scale with the revenue. And yes, you will
Yeah.
have certain scale effects at some point. For example, a classic one would be procurement effects from volume buying, etc. So that is not to say that variable costs can still be optimized. That much is obvious, but in general, it will become larger as your revenue goes larger. Fixed
Mm-hmm.
cost, on the other hand, typically, and there's a subset of that which is a jump fixed cost, typically does not scale with your revenue or scales in certain jump steps with your revenue as you build up, for example, a new department or a new market, a new geography, whatever. But
Mm-hmm.
in general, it will not be sensitive to your revenue. So that's a
Yeah.
fixed cost item. So practical example of a variable cost would be if you produce a material, the input or the raw material, the energy cost, those would be variable cost. You would not consume them if you don't generate revenue with it, if you don't
Yes.
produce for your revenue. The fixed cost, on the other hand, classic example would be your CEO's salary or the office,
Mm-hmm.
etc. Those are there anyway. And in fact, we call them in German even anyway cost. That's a
Mm-hmm.
literal term that we use here, because they are there anyway, regardless of how much or how little you sell. But at some point, if you sell more, maybe you need a bigger headquarter, or maybe your CEO will ask for a higher salary. So that's the jump fixed portion
Yeah.
of the fixed cost. But in general, they will not be sensitive to the revenue.
Yeah, I mean, depending, on where our viewers and listeners are, these terms may be called by slightly different terms as well. So, variable cost may also be called direct costs, if that's a term you're more familiar with, and fixed cost may also be called either indirect costs or overhead expenses, depending on where you're based.
Yeah. So now to the contrarian perspective. Let's start maybe with just what made the software model so attractive to so many people in the context of variable versus fixed cost. Sure. What is software in the end? Software is, I try to make as little investments, ideally one time only, to create one product, and that's a fixed cost
Mm-hmm.
item. And I try to do as little updates or maintenance to that software as possible.
Yeah.
And that is attractive because then everybody knows I can sell 1 million copies, 1 million seats, 1 million licenses without much incremental cost. There's some incremental cost to it. One
Mm-hmm.
is maybe the cloud cost that I have to pay, and they will scale with my revenue as I command more processing power or more cloud storage.
Mm-hmm.
The other one might be customer service work hours from my CSM team, bug reports, helping customers fix whatever account logouts,
Yeah.
lockouts, etc. So those would be variable cost items, and then a big variable cost in software historically can be distribution, basically. So
Mm-hmm.
the so-called customer acquisition cost would fall into this category.
Yeah.
So Shub, why was that attractive for investors to have that big of a fixed cost compared to that low of a variable cost?
I mean, before I answer that, the other thing to keep in mind, which also is a vector to, I guess, distribute the fixed and variable costs, is even in software, we started off with a license or on premise based system, and we have gradually gone to
Oh, that's a great
cloud and
point.
subscriptions, right? So
That's
that's a
right.
further way to distribute the cost basis even further. So the argument was that, hey, if you have this intellectual property which you need to invest a great deal upfront, and it is hard for you to administer this as either a service or something which needs to be provided in a certain either consultative format or selling format, or in a format that cannot be delivered digitally. And therefore, if you provide this, okay, I was about to say software, but that's kind of a circular logic. But let's say if you offer this service or this product in this format, which can be consumed infinitely, you have essentially created in a theoretical construct a situation where you have perpetual annuity of income, especially true if it's a subscription, where the cost progressively declines because presumably you already have your cloud storage expenses, which will presumably decline over time to a negligible proportion, etc. So the theory is, hey, your profitability will improve greatly, and because a lot of the assets you have taken on upfront, you will amortize over the first, let's say, 5 years, 10 years, give or take. After that, you're looking at a pure profit stream, and that, as is true for many companies, great companies like Microsoft, Oracle, Salesforce, etc., it has proven to be a tremendous model.
Now, here's where I'm going to add a little bit controversy to the fire. So you were exactly right. So the original software model was not software as a service. It was, selling disks,
Yeah.
CD-ROMs to customers for a one-time payment, and then you would annually collect sort of recurring, but not truly recurring, because you couldn't plan with it,
Yeah.
updates to the software, right? And so
Yeah.
you would say, hey, you have a license for this kind of thing. Now we're charging 20% for next year for you to get the new version, which is fair enough because you made certain new fixed cost investments to actually build the updated version. And that's where software as a service came in and was like hailed as this great model. Where you actually said, hey, let's kill the whole logistics part of the distribution. Let's kill the having to reach out to my customer to actually buy the upgrade portion of it.
Yeah.
So we actually move the distribution more and more into fixed cost. That's the beauty of recurring revenue in SaaS is I convert distribution variable cost into distribution fixed cost. That's very important here in this context. But the one thing that it did not do, at least most, and then I'm giving you an example for software as a service that didn't do, is it did not convert from fixed cost in the customer P&L to variable cost in the customer P&L. So let me explain. A customer purchasing a SaaS license, a seat, will have that as a fixed cost, which does not scale with your customer's revenue. So
Yes.
I have the license for whatever Revit, regardless of whether I sell $10, $1 million, or $10 million. The license
Yeah.
is there. That's the weak side of the SaaS model that nobody talks about. So my customer has my license as a fixed cost. Now, the beauty is when I can produce fixed cost, like software, but I can sell it as variable cost to my customer. And here are examples in the software world: fintech and cloud storage. So if you have payments infrastructure, you actually build up a ton of fixed cost initially until you see the first dollar of revenue. But later, your clients will get charged a percentage of the GTV, the gross transaction value. And in cloud storage, to the example that you gave in the pre-brief, AWS is the exact same thing. You build up a lot
Yeah.
of fixed costs, and you do have some variable costs with regard to the energy usage of your server
Yeah.
farms. So there is some variable cost item there. But overall, you're charging your customer a variable cost, actually. Why? Because
Yeah.
it scales with their revenue. The more they actually do, typically the more storage or the more processing they will purchase from you. It's not hypersensitive to the revenue of your customer, but it is variable. So these are fantastic examples of where you produce fixed cost, but you sell variable cost. And that's superior to the SaaS model that I think many founders have not considered. And we'll get to AEC Tech in a second, but just conceptually, this is how we think about it.
Absolutely. I mean, just to insert another example there, one piece of jargon which is often inserted to describe infrastructure buildup is to say, hey, build the rails of the system, right? So, just to remind our viewers where rails come from, I mean, those of you who are from the US or from North America in general, if you're familiar with Class 1 railroads, the likes of Canadian Pacific, Union Pacific, etc. They have like a monopolistic business. All of this is very old infrastructure, built 100 years or even older ago, perhaps. And it's kind of all that. There's hardly any additional cost. I mean, definitely no cost to create the infrastructure. Maybe just a little bit to pay the people, the staff expenses, and maybe some maintenance, etc. And that's it, which is why those are, a lot of people presume that stuff like railways must be low income. Those, look up those businesses, their earnings reports, those are extremely high margin businesses for precisely the reason you mentioned, Patrick. The investments have been made a very long time ago, and now the revenue, of course, is on a variable basis, either on tonnage of freight or the number of people traveling, etc. But the costs are not scaling in that on that basis.
Power plants, the exact same
Hmm.
thing. So if you had a permit to build a nuclear power plant in the 60s and you could forecast that you could keep it running for 50 plus years, that's a fantastic annuity. Obviously, you had billions of fixed cost, but you had far in excess of that in revenue that you sold as variable costs. Same thing. Telco
Hmm.
towers are
Yeah.
I mean, telco towers are for infrastructure private equity. They're always a great business because you have a relatively low fixed cost. One off, there's almost no maintenance to a telco tower. There's
Hmm.
almost no variable cost to a telco tower. A little bit of a of energy consumption,
Hmm.
but you're selling it variable. So it's a beautiful annuity model. And so
Yeah.
now with that definition of why actually producing fixed costs but selling variable costs, let's move into the AEC tech space. Shub. So
Hmm.
now that we understand what's beautiful about it and where actually SaaS is short. So SaaS has been great. It has been delivering great outcomes for founders, for
Hmm.
investors, for business as a whole, but it's actually short. This one metric because it's typically
Hmm.
selling fixed costs, not variable costs, except for the two examples that we gave. Let's move
Hmm.
into AEC. Shub, what is the
Yeah.
first example we're thinking of here in Fundamental when we think of this model of producing fixed costs but selling variable costs?
So I would say outcome as a service, which itself comes with many different flavors and iterations, as we've discussed in multiple episodes of Practical Nerds. Uh, I mean, why don't I think you should talk about outcome as a service, Patrick.
Yeah, we've backed a few outcome as a service companies over the years. So let's briefly define what outcome as a service for us is. So outcome as a service is where in the industries of construction, renovation, logistics, blue collar and trades, oftentimes these industries would be more used to purchasing guaranteed outcomes. So that could be a
Yeah.
subcontractor that promises you to put a wall in place or to paint a wall. It could be in the renovation case, an energy audit being done to a building. So rather than purchasing and in logistics, it's the same thing, Shub, for
Hmm.
always. Like, hey, I don't want to
Yes.
rent your truck, bro.
Yeah.
I want you to guarantee me that this shipment gets picked up here on time, gets delivered there on time, and in the meantime,
Yes.
nothing gets lost or damaged. That's the definition of an outcome, right? That I
Yes.
purchase. And so these industries, and a lot of that in heavy industries actually, are very used to purchasing these outcomes because it transfers risk in an otherwise already risky business, and construction is the epitome of that with its
Yeah.
project nature, etc. And this being used to purchasing outcomes has translated into governance, into P&Ls, and into culture.
Hmm.
How people have organized themselves in order to purchase guaranteed outcomes versus tooling. So now, if I try to sell them tooling, especially as a fixed cost, I'm not taking over the guaranteed outcome and the risk for it, and I need them to make certain changes to their workflows, to train people, blah 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 blah. So purchasing outcomes is much
Hmm.
easier for me. Now, the beautiful side for the startup or the company producing outcome as a service also kicks in because if I am truly a tech company, which many VCs, it took them a long time to realize that you can be a tech company as an outcome as a service. You are a tech company if you achieve one thing. If you sell variable cost,
Hmm.
outcomes, hey, the more revenue I make, the more I need to purchase this outcome. If I sell variable cost, And initially, I might produce a variable cost because I might just replicate the work that is being done by consultants, for example, today
Yeah.
with other manpower. But if I now have the money to invest in technology to replace my labor to produce the outcome, I'm converting my production of variable cost into the production of fixed cost. And if I succeed in doing that, my OAS model all of a sudden produces fixed cost but sells variable cost. And that's
Yeah.
how I get 90% gross margins and how I get highly profitable in the long run.
Yeah, absolutely. I think, and obviously, in this case, because of another thing we have spoken about before, which very directly relates to this problem as well as opportunity, is the trust deficit in construction, which you have spoken about in one of our recent episodes. If you lean into it with the outcome as a service model, you're solving for the trust deficit with a pricing model and I guess a product and a value proposition that the customer understands. And now, of course, it's up to the cost part of the equation for it to gradually decrease as a percentage of revenue over time.
Exactly. So,
Yeah.
I mean, enter in our portfolio here in Europe, the market leader for energy audits for building owners, both portfolio as well as individual asset owners. It's probably a great example of that. They have built an amount of technology that nobody on the outside is even grasping today, and they have converted so much of the original. So originally, this was a variable cost production kind of business for not just Enter, but for everybody around it. And this industry has been like 30, 40 years old, where engineers or architects would invest their own man hours in order to do an audit of a building and then produce a very sophisticated report alongside DIN and ISO norms, etc. And so companies such as Enter, which is, in my opinion, the European market leader, has invested into technology in order to use less and less and less and less and less of these person hours to produce the same kind of outcome. So that's conversion into fixed cost, but still selling as variable cost, which is amazing. And it allows you to do something else. You can all of a sudden disrupt the market if you play it smart, right? So you can all of a sudden offer different price points. You can all of a sudden offer spin-off products that are fully automated. And you can basically disrupt the variable cost competition from the market if you truly achieve to build a fixed cost production type outcome as a service that sells as a variable cost. So to me, that's
Yeah.
pretty beautiful. We have a second OAS example that I want to save for the end because they have an even more interesting thesis that is more hybrid. Shub, the second example that we have is cloud manufacturing in
Yeah.
construction tech. So Inframarket being such an example, Metalbook being such an example, Zwork being such an example. We have a stealth company in Europe that does something like that. For example, in the US, Equipment Share, I would also sort of call cloud manufacturing. So
Yeah.
you're the OG of this category in construction tech. So tell me why this is producing fixed costs but selling variable costs.
Yeah. So, firstly, I think there's a few different versions of what cloud manufacturing can be used to do. And I think we're seeing even more evolved versions of cloud manufacturing. Maybe let's call it cloud manufacturing 2.0 come up, literally in the last few months, which we're very excited about. And basically, what the model entails is on the demand side, you're, of course, selling to clients different products which are manufactured or produced in facilities and so on. Let's say the old marketplace model would be, here you source it from some manufacturer, some supplier, you solve for logistics, operations, and so on, and for matchmaking, and you deliver the product.
Which, by the
Now,
way, in that instance means your cost bases that you're producing are variable because you only produce them
completely
as your
variable.
revenue.
Exactly, it's completely variable. Now, what is happening is, as some of these marketplaces have evolved and grown in scale and matured as a platform that carries some sort of brand value and trust value on the demand side, they also represent scaled up platforms with very predictable demand and revenue generation opportunities for the supply side. So, quite a few of these platforms have then turned over to the supply side to say, hey, you know what? Why don't you sign exclusivity or something resembling exclusivity with us as a platform? In return, we have first rights over your produce, and we get to market it as our own brand and private label brand. Now, this comes with, and obviously, this often comes with some guarantees or implied guarantees of quarterly demand predictions, what you'll purchase from the suppliers and so on. But what that also means is you have complete control over access to the manufacturer's production capabilities. And you can use that to push specific products, new private labels, recommend new kinds of SKUs, referencing what you had mentioned, Patrick, cross sell and upsell different categories, which now you have great control over producing with your suppliers and your manufacturers. So
So I
you
buy
are running.
capacity.
Correct. So, in essence, think of it, it's not too dissimilar, Patrick, from the evolution of Amazon because Amazon knows what the customers are looking for. Amazon is also in a position to recommend a lot of Amazon basics and other Amazon private label products. Or how
So
Netflix, sorry, just to complete that analogy, or how Netflix is in a position to recommend Netflix originals.
hey, that's a great point. Actually, content creation is also for. I was saying Hollywood studios. Is that such an example? So you have fixed costs for the movie production, post production. So that part is probably correct because it
Yes.
doesn't scale with how much of the movie I sell in the end. So that's a fixed cost item. Do I sell it as variable cost? Yeah, because if I want to consume the movie again and again and again in a cinema or
Yes.
in a DVD fashion, it would be. I'm not sure how they structure the deals with online streaming platforms, whether the revenue also scales the more the film gets viewed on the platform. So here I lack knowledge whether that's the case.
Yeah, I don't know enough either. I don't know enough as well. I think with I mean, as a general rule of thumb, what I've observed is, I guess, the bigger the star, the more likely it is to not be actually a fixed cost. It is more
Yeah.
likely to be a variable cost because they know that's where the money is at.
So beautiful model, right? So I produced fixed cost, but I sold as a variable cost. In cloud manufacturing, should double click with me on this. So cloud manufacturing, inframarket being, in our opinion, the front runner of this in construction materials. It's the largest construction materials one-stop shop that we know of globally. What exactly do they do to produce fixed cost and not variable cost?
So, look, to be just to be clear and set expectations, it's not fully fixed cost, Patrick. At least not just yet. I mean, it is more fixed cost than a marketplace, but it would be more variable cost than a traditional building materials producer.
A
So
traditional building materials manufacturer would be someone who invests 500 million in a cement plant
yeah,
and then so they're not doing that. They're asset light,
yes.
but at the same time, they have a high fixed cost portion.
So the fixed cost portion here would be because you, as a producer, as a platform, know what your likely demand is going to be for the next 3 months, 6 months, and you have the certainty of a large demand. And in other words, you can give certainty to your manufacturers to say, hey, you know what, I can guarantee that you'll be utilized for 90 or 100% for the next 3 to 6 months. Therefore, I'm locking up your capacity. In return, either give me output of your output at a certain price, and let's say it's a fair share below the market price, or at least whatever infra market expects to sell it at, or actually no, I was about to sell an all in a different market structure, but that other market structure does not apply for infra market. It is just the former, because you have committed to very high utilization and very high throughput over say the next 3 to 6 months. The calculation which the manufacturers do at their end is not on a per unit basis, but they calculate the aggregate earnings they would make. So, in other words, let's say it's a certain price per ton of material multiplied by the number of tons of throughput over 3 months or 6 months. The manufacturer is saying, hey, you know what? Should I optimize for unit price or should I optimize for my overall revenue? The
Yes.
calculation they're doing is, hey, I'm getting certainty of revenue through infra market, so I'll just optimize for certain. Even if I price it lower, I'm moving a great deal more of product, so I'm earning more, and that way infra market benefits as well because they get lower pricing. So it is fixed cost for infra market in the sense that they have locked a lower cost base for quarters at a time, and they can keep moving
Exactly.
this along as they get certainty of demand.
And some cloud manufacturers might actually be on the hook to then pay for the capacity because they might have given a revenue guarantee so that the manufacturer is comfortable blocking the capacity For that, I've negotiated a favorable price for both parties. So in that sense, it is a fixed cost because if that's the case with some cloud manufacturers, you would be on the hook. Now, for the plant owner, that's great because in the end, if I have so high fixed costs in my plant, I need to utilize it. So I just transferred the utilization risk to the cloud
Yes.
manufacturer.
Absolutely. Yeah. The cool thing is, as I mentioned, we're now seeing versions of what I'm referring to as cloud manufacturing 2.0, where these are much more brand centric, IP centric, even more service centric plays in cloud manufacturing. It seems like the next evolution of the cloud manufacturing playbook. These are obviously still much earlier stage companies we are seeing and looking closely at, but I think they are also taking this fixed cost, converting the variable cost to fixed cost aspect of what we're discussing to the next level, incorporating things like IP, brand elements into it, etc., not just doing at a cost. So I find that also quite interesting on how that model is evolving.
So that's the cloud manufacturing part where, hey, cloud manufacturers, and I loved how you contrasted it to traditional
Mm-hmm.
marketplaces because it's not fixed cost, are actually producing fixed costs as much as they can and selling as variable cost, which, by the way, is even cooler in a economy like the West, where the building materials prices will only know one direction for the most part,
Mm-hmm.
due to energy costs, due to lower and lower raw resources. So the more I can produce fixed costs and sell variable costs, the bigger the spread I will likely be in. Now,
Actually, you know what?
the one thing
Oh,
that
sorry.
my
Go ahead.
technology needs to do is,
Mm-hmm.
and sorry, not just technology, but my overall model, just to double underline what you pointed out, is I need to create high predictability of my variable cost return.
Oh, yes. I mean, this model works only if what you're. So, look, the manufacturer will only give you these discounts and the privilege of using your own brand if you can represent a offer a certain certainty that the product is moving and their facilities will be utilized productively at high utilization rates for the next few months. If that's not the case, it's either a non-starter or a very expensive proposition for the platform because essentially then you will be expected to pick up the product.
Now, everything that you just described sounds like robotics to me. So why don't we discuss robotics in construction?
Sorry, before you go there, I know you set up the perfect segue. I just want to do like a tiny I guess branch out related to cloud manufacturing.
Okay.
It's more cloud contracting model, which, for example, we're seeing very nice effects of with our firm Brick and Bolt, for example, where it's a very similar effect when you have quite a bit of demand built out through lots of contracts for contracting work in home building, etc. Contractors see visibility to a large pool of work and predictability that they will earn more as an aggregate. And therefore, on a per unit hour, they're okay with being paid less because
Yes.
they're productively engaged that much more on a per day or a overall utilization basis. So I think you can, when we say cloud manufacturing, we're talking about improving asset utilization and using that as the basis for uh, going from variable cost to fixed cost.
Yeah, and look, I mean, and I don't know if Shoe Brick and Bolt is your portfolio company. By the way, a terrific portfolio company. Excel invested after us, and we have high hopes for the firm. They are doing in the booming Indian economy home building in the cloud manufacturing model. Um, but if models like Brick and Bolt wanted to, they could, my guess is, also convert the contractors at fixed cost, or maybe the top 10% of contractors, where you
Yeah,
say, hey, I want to lock them down as my capacity. I know I can always utilize them in this area. So probably will not make a contractor travel from North India to South India. So probably I wouldn't do that. So I need to be a bit regional that way. But the top 10% of my contractors, I would want to lock down. I would basically just say, hey, I'll give you work the whole year. Just don't sell anywhere else. Here's the
yeah.
guarantee. Let's guarantee each other. And then it's a fixed cost item. So
Hmm.
now, robotics. And I think this is exactly where both investors and founders in construction robotics got it wrong for the longest time, because robotics is notorious among investors as, or I should say, has been notorious among investors for the longest time as, oh, hard tech produces so long times to revenue, and there's so much investment needed, and then it's so dilutive, and I don't know whether the market will accept the technology, then there's still tech risk. So I'm stacking all these assumptions on top of each other. I don't know if robotics is for me. Like seriously, when you zoom back to 2021, sure, you would not find a ton of VC investors that actually loved to go
I mean,
into robotics.
to be perfectly honest with you, Patrick, some of the statements you said, I know you're referencing so-called other VCs. I feel like a lot of those were my own statements.
Yes, and in low labor cost economies, it's difficult to make it work because robotics essentially is converting variable cost production into fixed cost production. But if your variable costs are extremely low, like 70 million construction workers and helpers in India, and then you have to invest a lot into converting it into fixed cost, the business case does not make sense always, right? So you have to produce it in the local market context. Whereas in high labor cost economies, that spread can be captured by fixed cost conversion. Now, where you have to get it right, though, is they're not selling it as fixed cost. And that's what
Yeah.
VCs and founders, I think, for the longest time got wrong. And I'm going to give a few examples where they got it wrong. And then there are actually examples from the drone space, which I thought initially were getting it right in opposition to the investors. So traditionally, the construction tech robotics companies were producing a lot of fixed costs. Build Robotics raised how much, Shub? In excess of 100 million US dollars?
Yeah, definitely. I mean, yeah, if I had to take a random guess right now, I'd say maybe between 120 to 150-ish million.
Yeah, so that's one of the first companies in construction robotics. I believe Noah founded it in 2015. I haven't checked it, but I think my memory is something like that.
Yeah, I think that sounds right. Yeah.
Yeah, Canvas Robotics, about the same time, well, about the same generation of construction robotics companies. I would have to check it, but probably raised between 60 to 70 million US, at least that I publicly know of. There might be some stuff that hasn't been published yet. And this generation of construction robotics companies was taught one thing: oh, sell robotics as a service. And the problem with that is, let's first define it. In the end, oftentimes the way founders frame it is, okay, you can lease my robot for an annual recurring fee. Sometimes they would agree to a monthly recurring fee. And sure, that gives me a spread because I have a certain cost to produce a robot. And by the way, I'm not talking even about R&D. The R&D fixed cost comes on top, but I have a certain cost to produce one robot to deliver to you. I have a certain logistics and delivery cost, and then I have a certain uptime costs that are more variable or sort of variable. But if I now basically converting into a leasing fee, it does not scale with your revenue. You know, it's your utilization problem, dear customer. You pay me 100,000 a month for that robot, regardless, and that's exactly wrong for multiple reasons. One, customers in construction want to buy outcomes, guys. We discussed it so often here, and if you're in construction long enough, you will have realized this as well. They want outcomes. They want guarantees. They don't want tooling or hardware in the current stage of construction. I'm not saying that can never change as construction matures and adopts technology. I actually do expect it to change because they want fixed cost rather than variable cost at some point. But for now, that's the state of the industry, and that will continue for a while. Two, trust issues. To Shub's point, so that's another one. And three, hey, I actually want to sell as variable cost if I want to make capture the spread between fixed cost production but variable cost selling. So that's why the RaaS model or the leasing type model, the subscription model, basically is wrong. Along came Monumental in our portfolio. Monumental does bricklaying robots. It's an amazing team, raised money, but very capital efficient, not anywhere near the numbers that we just discussed. Company was founded only in 2021, and they are doing one thing, Shub. They are selling variable costs because they are offering themselves as a subcontractor, not as, hey, you can buy my robot, you can lease my robot or whatever. No, I'll buy the wall for you. I'll put the wall for you. You can buy the wall from me. And if you want more bricks, the price goes up. I'm selling variable cost, but I produce fixed cost. And by the way, the fixed cost for one Monumental robot, that's a pretty darn great business case for Monumental. So this is what as a construction robotics company you want to do, produce fixed cost, but sell as variable cost as a subcontractor. If you can find these models, that actually flies.
I mean, to our viewers and listeners who haven't already watched it, I highly recommend checking out the super series that our good friends, the Bricks and Bytes guys, did on Monumental. I think like a month or two ago, Patrick, if I'm not mistaken.
Yeah, I want to say
Yeah.
Q4. Yeah, that could be right.
Okay. Yeah. So I highly recommend checking it out because I feel Monumental is unlike any other robotics company you've come across. Also, in a weird way, it's unlike any other robotics company you've come across. They kind of give a traditional company vibe, but it's also unlike any traditional contractor company you've come across.
I agree. Now, there were early indicators, I think, of this model. If we as a venture industry had paid attention, if only. So let's talk about drones for a minute.
Mm-hmm.
Drones today, they have an image, sorry, in construction and infrastructure, they have an image somewhere between boring, undifferentiated, and oh God, no, I would never invest in there. But if you go 10 years back, this was the hot shit actually in
Mm-hmm.
San Francisco.
Yes.
Companies like Propeller, Drone Deploy, etc. They
Yeah.
raised a lot of money. Propeller is a Sequoia company, if I remember correctly.
And Axel. Yeah.
And oh wow,
Yeah.
okay, so
Yeah.
that's a great
Yeah.
cap table, right?
Yeah.
So originally, 10 years back, the premise of these companies was exactly that. Let's sell the hardware. And by the way, I mean, there was a Chinese company that built consumer grade drones that then leveled
You
up
mean
into
DJI?
professional DJI.
Yeah.
Exactly. Highly profitable. And so with that, the whole West thought, hey, let's replicate the success. Let's invest into R&D. Let's build fixed cost. And then let's sell the things, right? So let's sell the drones. Over some evolution, they came into the leasing model. But then something happened, Shub. And I think Propeller is one of the examples of that. They discovered the outcome as a service model, didn't they?
I believe so. I mean, the disclaimer here is we haven't caught up with them in the last couple of years or so. But more and more, a lot of these firms have evolved into service or outcome as a service companies,
Pay me per flight.
not offering the drone as a solution by itself.
Exactly. And pay me per flight. I mean, these flights are relatively costly for the customer. They have a high willingness to pay, but they are not necessarily costly for me as a drone operator because the fixed costs are already produced.
In fact, tell me if this is one of your observations, Patrick. I think 2018, 2019, a lot of these companies would highlight the technological capabilities of the drone or the hardware as the differentiator. Now, a lot of them by starting off like, hey, our value proposition is not the drone or not the hardware.
Yes.
We are just a platform. We are hardware agnostic, etc. It's quite fascinating how that has changed in just 4 or 5 years.
I've matches completely my observation, and in fact, one of the larger incumbents that we speak regularly with is Hexagon. Hexagon is a mix of a hardware and software incumbent, highly profitable business. If I remember correctly, they have about 1 billion, 1.2 billion of free cash flow every year. I have to double check. I
Nice.
don't want to say something wrong, but that's what my memory tells me from the last
Okay.
time I checked. So highly profitable, and one of the business lines that they have is, so they do sell hardware, they do sell software, but they also sell services, meaning drone flights. So for example, they go to city planners and they say, hey, we digitalize the whole city for you. Here's the cost item. So I can only assume they use their own hardware for it. It would be quite weird for Hexagon to purchase someone else's hardware. So
Yeah.
that's an assumption. So now I have all this hardware produced as a fixed cost, and I can sell it as a highly profitable outcome item.
Yeah.
Now the trick here
So
is, oh yeah, go ahead.
Oh, I was actually leading because I think clearly, it's a gem you found with Monumental, and I fully buy into the thesis you have laid out. Are you are you seeing the message diffusing into more and more founders in the sense that are more founders, founders building in robotics? I mean, getting the memo that hey, you need to switch up the playbook a bit to actually access what the market might be willing to pay in
So
robot
great
pay
question.
for
I'll give you
robotics.
two answers. One, in general, the things that we share on Practical Nerds, regardless of this fixed cost versus variable cost outcome as a service, in general, it's unbelievable how much of a reach we have now. And I know you have these things, but it happens to me so often that people say, hey, I listened to this episode. It changed my perspective on this. Now we're doing this. Can we talk? Or I've been enjoying a lot of what you guys talk about. It's so refreshing because it's contrarian, and I believe it's right. This happens all the time. It really does. With regard to the OAS model in robotics, fixed cost versus selling variable cost, yes, compared to, let's say, 2 or 3 years ago, there's a noticeable difference. And I think that's not one that we should, you and I, we shouldn't pat ourselves on the back here. I think that's mostly because of the founders actually executing, and other founders seeing it. It's more just we spread the message, but the proof is done by the founders. But it's not to the degree that I would like. And I think I see two types of founders, and the difference, and they have a difference in how they resonate with this. So I see tech first type robotics founders, and I see product first robotics founders. The tech first robotics founders sometimes would have researched a specific automation discipline or something similar at a university or at a large corporate for a long time. And then they say, hey, now I can do this on my own because I have mastered the technology. These guys take, in my conversations, longer to warm up to different commercial models, to discussions about P&L, to discussions about fixed cost versus selling variable cost. The product first robotics founders, and Salar and Sebas at Monumental are exactly those. They come with a completely different mindset and skill set oftentimes. They would say, hey, the technology, we can master it. And actually, if we approach a software shipping type of mindset, we believe we can produce it faster and cheaper than if we come with a full automation mindset. But because they have this mindset, they're also constantly thinking about the commercial side of the business, how to fix distribution, how to maximize margins, etc. So the second type of founders, it typically takes like half an hour of a conversation together to figure this out.
Oh, I must say I'm pleasantly surprised. I don't see as many robotics founders as you do. For some reason, I've held this stereotype, maybe it's a prejudice, that robotics founders feel very strongly, I guess, about the part of the market they occupy, and they are, maybe for good reasons, maybe for not so good reasons, hesitant to change, to go into what is unfortunately perceived as a more traditional and a less sexy direction for
I think
startups.
there's a generation of robotics founders who is like that. I do see a new generation being nurtured right now through the community that they operate in, of other robotics founders, of VCs that have a particular taste to robotics like ourselves, that are coming on the market in the last 2 to 3 years with a completely different mindset, and one that is actually more like software fixed cost production and selling variable cost as outcomes. I'm seeing that quite a bit, I have to say. Those are the ones that at least I am attracted to. The other ones that I have more of a traditional automation mindset, I'm not attracted to them.
I see.
Yeah. Now, before I come to the special hybrid example that I saved for the end, Shub, so I think what's important here is if you produce fixed cost, but you want to sell variable cost, you are assuming utilization risk. That's the key point to highlight here. So you better be great at distribution. If you can't be great at distribution, this model will not work and you will leave a lot of money on the table. The beautiful thing about construction is selling outcomes is actually oftentimes the easier distribution, isn't it?
Yeah, absolutely. It may, again, I think going back to my earlier comment, it may seem like you're being given like a less sexy challenge, or you're not really a venture founder if you're told that you're selling outcomes. But hey, if you judge yourself on product market fit, on traction, on scale, on value creation, I think you will find soon enough, if you just give yourself the opportunity to test it out empirically, selling outcomes is indeed the way to go in construction. Certainly, the way construction is today.
And there are established channels for it. There are tenders, there are RFQs, there are purchasing processes tuned to buying outcomes, there are budgets for it. The personas are extremely clear who purchases this. In renovation, it's the same thing. In logistics, it's the same thing. So logistics and supply chains, it's the
Yeah.
same thing. So actually, when sometimes, sorry, almost all the time I catch founders under obsessing with distribution and underthinking distribution. In the context of construction, they sometimes also overthink it. Actually, the distribution into construction and renovation and logistics can also be really, really simple if you just commit to selling variable cost as an outcome. But it's hard to unlearn it because 20 years of VC industry taught you, no, you should be software. It's exactly what we're discussing today. No, go to the first principles. Produce fixed costs, sell variable cost, if that is something that the industry buys at a large volume all the time. So Shub, the hybrid example. Sorry.
Oh, sorry. I think there was a lag. Please go ahead.
So here's the hybrid example. So I have a company in my portfolio. It's very early, and I won't speak from a perspective of, hey, this is proven. This is a thesis right now, and our viewers and listeners, don't take it as gospel what I'm about to say. It's just a thesis at this point. That's important. But there is a company in my portfolio that sells outcome as a service into grid reconstruction. So the reconstruction of the power grid infrastructure. The purchasers would be utilities, transmission system operators, distribution system operators, so TSOs, DSOs, the likes. And so here, the production is oftentimes variable cost because you're hiring labor as a subcontractor or sometimes as a temp labor to perform a certain task for you. And this labor oftentimes would not guarantee, the labor on the payroll of the subcontractor has no guaranteed outcome to it. Their cost scales with the amount of hours that they work for you. And so this is then being sold as variable cost to the infrastructure customer. So this company has an hypothesis that the utilities, TSOs, DSOs, etc., metering operators, that they are willing, because of the shortage of able bodies to actually perform the work, if this company of mine is hyper successful in actually acquiring talent and train the talent, standardize the processes, their thesis is that these utilities, TSOs, DSOs, metering operators are willing to purchase a guaranteed capacity at fixed cost, but price it as variable cost, and in excess of the minimum guaranteed, purchase more hours fixed. So what could that be? For example, let's say one of the workers costs you 5,000 a month as fixed cost, because that's what this company now does, as fixed cost. And you could sell it to a TSO for 10,000 retainer per month. But the deal structure is, hey, we still price it by the amount of hours that they work for you. So basically you use up your capacity against billable hours. And then in excess of that, if you purchase more hours, it gets still priced as variable. The trick is you guarantee me the 10,000. So I have a guaranteed 100% margin on my fixed cost. You can use, but you have the utilization risk, dear customer. And if you go in excess of that, you have to pay further variable, but you didn't guarantee me that. So that would be a hybrid model where you transfer the predictable demand and the utilization to the customer, but you still charge it as variable cost.
It is an interesting model, I have to say. It again goes back to our point on if you have predictability of demand, because I presume a model like this would make sense if the customer feels comfortable or feels there's a reasonably high probability that they'll use up the the minimum allowed, not allowed, sorry, the block of hours covered by the minimum guarantee. They'll be able to use that person.
And if the if the production supply is very short, I might actually be enticed to do this, because in the end, it is there a demand overhang versus the supply or not? Is the supply hard to get, and is the demand just so much overhung that it makes sense?
Or in a weird way, creating yet another meta argument on the fixed and variable cost, etc. While the discussion may be on the cost, in this case of labor, what the client is more interested in is getting the outcome of the infrastructure built and that's a much bigger cost or revenue driver for them
Oh,
than
yes.
the shift in the cost of the person involved.
That's a great point too.
So
Yeah.
they are
So
probably
this,
doing a different sort of computation. They're doing a computation. Hey, if this infrastructure gets up and going a few days earlier, I don't mind paying for this excess capacity, or what? Not necessarily excess capacity, but the guarantee of excess availability of workers.
it's a great point. So so this specific hybrid model, which from a cash flow perspective is guaranteeing me fixed cash flow, but from a P&L perspective, it's still selling variable cost. That's just a thesis. So listeners, don't take
Nice.
this as gospel. This is the one part of this episode where we don't speak from factual experience just yet. This is being tested as we speak.
Okay. I think hopefully in a future episode we'll report back that this was like a
Yeah.
successfully implemented pricing model.
Yeah, hopefully. Hopefully. Cool. I thought this was a great episode, Shub. And just in summary, software is great, SaaS is great, but it is selling fixed cost as fixed cost. The
Yeah.
infrastructure plays have achieved to sell fixed costs as variable costs, and that's what informs a lot of the great outcomes in construction tech, because construction tech loves to buy variable cost. Sorry, construction loves to buy variable cost. Renovation, logistics, they love to buy variable cost to outcomes. So the best founders will hack this model the way we laid it out.
Yeah. Yeah, absolutely. Look, I think quite often great VC models look very obvious as a function of traditional pricing, supply demand, cost and revenue sort of models and how they stack up. I would like to believe, this approach has legs, and a lot of great companies will take advantage of this in the years to come in
Great.
AEC tech.
So if you think that's your model, talk to us.
Absolutely.
Thanks, Shub.
Thank you, sir. Have a lovely holiday season and an end of the year.
You too. Ciao.
Cheers.